Hi, this is Andy Hoffman, Marketing Director of Miles Franklin Precious Metals, in our 26th year in business. It's Thursday morning, August 6, 2015, and the title of this week's audio blog is, "Oh no, the Fed's going to raise rates and crush gold," I say facetiously. Frankly, it's downright scary how many horrible headlines, all of them wildly precious metal bullish, I have to discuss this morning, all of them emerging in the past 24 hours. I'll get to today's primary topic, if that's even possible to discern in due time, as clearly the cartel's unrelenting attacks of the past few months, highlighted by July 19th's Sunday night paper gold massacre, combined with a frenzy of propaganda regarding a potential September rate hike, has taken the worst precious metal sentiment I have seen in my 13 years in the sector to new heights of fear, anger, and angst. Have no fear, comrades in gold arms, at least those that own physical metal, which is experiencing record demand, collapsing inventories, and soon to be imploding production, as opposed to paper PM investments like mining shares, which may well disappear forever, as not only are the Fed's machinations meaningless as relates to precious metals, but shortly they will not only be mocked by the entire world, but attacked by the smartest, most deep-pocketed investors. And speaking of the entire world, let's start at the easternmost part, China, where the world's economic engine is not just sputtering, but completely out of gas, with no brakes, shock absorbers, or airbags as it careens down an icy slope into a wall longer, stronger, and more unyielding than the Great Wall itself. I mean, it's really that bad, with not an ounce of hyperbole or sarcasm in such an analogy. In other words, as historic as the bubbles everywhere else in the world have become, with the exception perhaps of its demographic twin from hell, Japan, none even come close to the horrors Japan's red capitalism leaders have unleashed on both its own people and the world at large. Not that the West, led by America's self-serving lobbyists and politicians, didn't aid and abet the Chinese bubble for the past 2 decades, ultimately dooming 7 billion denizens to the twin horrors of commodity deflation and cost of living inflation. However, the Chinese government and central banks' cumulative actions have been so egregiously destructive, it's hard to believe they were actually manned by human beings. True, they do have 1.5 billion plus mouths to feed, which assuredly influences such decisions in a significant manner. However, any alien looking down at China's ghost cities, massive industrial overcapacity, comically fallacious economic data, and margin-fueled stock bubble would shake their head in incredulity, as likely nowhere in the universe has this much long-term global damage been caused by so few. Ironically, because China was the first nation to experience the hyperinflationary carnage of fiat currency 1,000 years ago, its people and government are wise enough to have acquired massive amounts of gold and silver with its ill-begotten trade surpluses of the past 2 decades. And thus, when the dust and smoke of history's most cataclysmic economic collapse subside in the coming years, China will, despite itself, be the world's leading economic superpower. That said, to say the Chinese economy is in free fall, with no hope of recovery for years to come, may be the understatement of the year. The fact that they claim to have a 7% GDP growth rate puts to shame the island of lies economic recovery made famous by the United States of fraud, although at least the Chinese government admits that said 7% growth represents the slowest such rate in 35 years. Which, of course, means they are in their deepest recession of our lifetimes, which even their own PMI manufacturing and service indices depict. And given that they are the leader of the so-called BRICS, which Goldman Sachs predicted to be the bastion of global economic growth for years to come, the implications for the rest of the BRICS and the rest of the world could not be dire. To wit, the average BRICS currency has plunged more than 90% in the past 4 years. And just wait until the Chinese yuan joins the party, when it inevitably devalues the yuan and joins the freefall collapse of the Brazilian real, Russian ruble, Indian rupee, and South African rand. As well as the Japanese yen, hitting a new 12-year low today, the euro, and dozens of commodity currencies, like the Australian and Canadian dollars, for instance. I mean, geez, just yesterday, a top Chinese official admitted its government has been not only massively understating the level of toxic PBOC-fostered bad municipal debt, but overtly lying about it. Supplemented by today's news that Chinese bad debt has exploded by 35% this year alone. Moreover, despite the most overt government manipulation I have ever witnessed, the historic Chinese equity bubble i.e. the second of its kind in the past 8 years, continues to inexorably collapse, down 30% in the past 2 months with no end in sight. Amidst the biggest retail margin explosion in history and stock valuations reminiscent of the late 1990s NASDAQ bubble, which incidentally are not much different than today's NASDAQ mega bubble, which incidentally is in the process of deflating dramatically. Take a look at today's market darlings, Tesla and Keurig Green Mountain Coffee and Fitbit. To that end, here at the Miles Franklin blog, we are considered tinfoil conspiracy theorists for discussing market manipulation openly, such as the U.S. Plunge Protection Team, which in reality is a term coined not by us, but White House insider George Stephanopoulos, in describing what in actuality is an official government agency created for just such a purpose, i.e. the President's Working Group on Financial Markets. Not to mention the U.S. government's Exchange Stabilization Fund, which has been around for 80 years with an official mandate to, quote, manage the currency and gold markets. And of course, the Fed itself, which manages the bond market by overtly and at times covertly manipulating interest rates and the money supply. But again, despite countless official admissions from everyone from the Bank of International Settlements to Bank of England governors to several Fed chairmen, most notably Alan Greenspan, not to mention countless recent scandals, from LIBOR to mortgage bonds, treasury bonds, and even the gold fix itself, and reams of empirical Six Sigma data, which could only occur in rigged markets, we are characterized as conspiracy theorists for even suggesting such. And yet, when Goldman Sachs itself, just last night, claimed the Chinese, quote, national team had spent nearly $150 billion covertly supporting the Chinese stock market in just the last 2 months alone, not a peep is heard anywhere of how markets everywhere are compromised. Oh well, I guess we'll just have to wait and see how they do against economic Mother Nature and her undefeated Ronda Rousey-like record of success, particularly in physical markets like gold and silver, where supply is vanishing whilst demand explodes. Meanwhile, as Japan's economy implodes and its population vanishes into the demographic hell its Shinto gods cursed it with, its aging citizens have taken to the streets to demand Shinzo Abe's resignation for the second time in 9 years, after his second unsuccessful attempt at reviving Japan's dying economy with the printing press. The land of the setting sun, which I've long predicted would be the first world economy to experience hyperinflation in the 21st century, has now seen falling real wages for the past 24 months, dating back, drumroll please, to just after Abenomics commenced in April 2013. In fact, July's real wage plunge was the largest in 6 years, as lo and behold, just like here in the States, nearly all new jobs in Japan are part-time in nature. Consequently, the yen has plunged to a new 12-year low of 124.9 to the dollar and looks dangerously close to a convincing breach of the key round number of 125, which, when it inevitably occurs, could yield a rapid, dramatic collapse to significantly weaker levels. Remember, it was just 4 decades ago when the yen traded closer to 400 to the dollar, and given the horrifying financial, demographic, and economic situation Japan faces, don't be surprised if it challenges that level much sooner than most can imagine. And then there's Europe, where as the National Bank of Greece's stock plunges to a new all-time low each day, we're told a third bailout is likely before Greece defaults on a $3.2 billion interest payment due to the ECB on August 20th. Frankly, it matters not whether something is cobbled together before then, as by year-end, Greece's collapsing economy will likely set new records for first-world financial horror, with the inevitable Grexit from the Eurozone and Euro currency more likely than not. As I mentioned last week, Southwest Securities' Mark Grant figured out that indeed Goldman Sachs did a masterful job hiding most of Greece's debt, which in actuality is closer to 650 billion euros than the reported, in and of itself horrific level of 350 billion or so. Throw in what is likely to be a bailout proposal of 100 billion euros or more, if it even gets done, and we're talking about Japan-like debt to GDP ratios. Only the bankrupt nationalized National Bank of Greece can't print euros to monetize such debt the way the Bank of Japan can. Of course, it can certainly print drachma, and in time it will, fostering not only Greek hyperinflation and social unrest, but the beginning of the end of the European Union generally, the pigs specifically, or as I deem them, the PFIGs, because France is in equally dire financial straits, and the entire Western monetary system. And for that matter, let's not ignore, the vile British Empire, which cumulatively has caused more global economic damage and death, slavery, and injustice than any other outside the United States of financial destruction, let alone its role in fathering the modern central banking scheme, fiat currency regime, and derivative-fueled global economic and financial nightmare, whose central bank, ironically, like its partner in crime, the ECB, is run by a former Goldman Sachs partner. This morning, the Bank of England again maintained its 0.5% interest rate and £375 million QE program. But get this, it claimed it was considering a rate hike in the first half of 2016. Yes, my friends, the first half of 2016, despite the first half of 2015 having just ended, and the BOE's clueless governors having not a clue what will happen in the next 12 months. Let alone, as by that time the UK population will have likely voted itself out of the European Union, yielding a dramatic reduction in overall European economic activity. Throw in the collapsing oil prices that threaten the UK's biggest business outside of criminal banking, i.e. North Sea oil production, the fact that when including the corporate sector, i.e. banks, England's debt to GDP ratio is the world's highest, and such claims come off more hollow than even the Fed's. Not to mention, I kid you not, the BOE suggested that the pound's, quote, recent strength could hurt its competitive position. Recent strength? Really? I mean, geez, the pound has traded in a narrow range of 1.46 to 1.72 to the dollar for the past 4 years, and it's 1.56 today, and only a slightly wider range of 1.4 to 2.0 over the past 25 years. This year it started at 1.55 to the dollar, fell to 1.46 briefly, and is back to 1.56 as I write. In other words, it actually has the gall to claim that the recent minuscule rise against the dollar, back to where it was a few months ago, could be a major deterrent to its economy. Well, enough of the right side of the pond's biggest criminals. Let's move to the left, where economic data essentially across the board has not only been abysmal and worsening each month, but in most cases is at or below the lows of the 2008-9 financial crisis. Not to mention the CRB Commodity Index, which earlier this week broke below the 2008 low, and each day since has broken down further. Remember, oil and gas has been the only business sector to have reported real job gains and wage growth in the U.S. since the 2008 crisis. And now it is in utter freefall, exacerbated by the fact that all such growth has been in the high-cost shale sector, which not only is financed by $500 billion of collapsing junk bonds and leveraged loans, but countless tens of billions of vanishing equity. And oh yeah, all of the above market hedges put in place last year, which essentially bought it a bit more time, are expiring, leaving it naked to the ravages of history's most oversupplied oil market. And this before Iran has even started to add 1 million barrels per day to the historic LOL peace agreement signed last month. Heck, even Goldman Sachs itself, i.e. the government's chief private cheerleader, claimed this morning that global oil storage capacity is, quote, running out. In other words, just as I was dead on about the inevitable failure of the blatant copper PPT that emerged this spring, I was about the same about the equally transparent oil PPT as well. As I write, WTI crude is on the verge of taking out $44 a barrel to the downside, en route to March's low of $42.35 per barrel and possibly far, far lower levels. Consequently, the CRB Commodity Index is now just 7% from the 40-year low set in the anomalous post-9/11 period, and only for a week at that point, as opposed to today when not fear but fundamentals are driving the historic collapse. Ironically, as espoused by the gospel of David Stockman's Great Deformation, which not only formed the basis of my must-read January 2nd article, The Direst Prediction of All, but my entire global economic horror thesis, said oversupply of not just oil but all commodities is the product of hyperinflationary money printing, financial engineering, and comprehensive economic fraud over multiple decades. And thus, to think that commodity prices could plunge so precipitously following decades of inadvertent hyperinflation of production costs shows you just how utterly horrifying the future will be. Let alone for gold and silver miners, which have not only had such horrors compounded by 15 years of government price suppression, but will unquestionably deal with nationalizations, windfall profit taxes, surging interest rates, and every imaginable political and economic horror once the gold cartel is inevitably defeated. Consequently, the U.S. economy has been in free fall for the past year, and this before the past 5 weeks' cataclysmic oil price collapse from $58 to $44 per barrel. This morning, for example, the Challenger job cut report exploded to 105,000 layoffs in July, representing its highest monthly surge since its highest monthly number since September 2011, which, if you remember, was when the U.S. lost its undeserved AAA credit rating, the global economy and markets were collapsing, and oh yeah, dollar price gold hit an all-time high of $1,920 per ounce. That is, when the world's governments and central banks hit their point of no return in vowing to spend every second of every day manipulating economic data, financial markets, and of course precious metals, starting with September 6, 2011's Operation PM Annihilation 1, when, incredibly, the cartel took gold from its aforementioned all-time high an hour after the most precious metal bullish event of our lifetimes occurred, when the Swiss National Bank, fresh from having sold most of its gold, pegged the franc to the collapsing euro in a move that, as we all know, spectacularly failed earlier this year. Scarier yet is that the large majority of said 105,000 layoffs were in the military, with only 8,000 related to falling oil prices. In other words, the current oil plunge will likely be accounted for by massive cuts in August and September jobs, and this following the aforementioned explosion of July layoffs, as evidenced by yesterday's utterly massive ADP employment report miss at just 185,000 new jobs with quotes around it, as if they even exist, versus 237,000 last month, when the labor participation rates plunged to a 50-year low versus the expected 210,000. And this before tomorrow's NFP report, the one the Fed considers the most important of all in its rate policy decisions. Well, that and inflation, and given that last Friday it was reported that July wage growth was its lowest of all time, it's quite difficult to comprehend how even government-controlled chop shops like CNBC, record low ratings and all, can purport impending rate hikes. I mean, what part of the weakest GDP growth in U.S. history, ironically made worse following last week's, quote, double seasonal adjustments, utterly imploding commodity prices, exploding layoffs, collapsing wage inflation, and oh yeah, the bursting Chinese economic and stock bubble, Puerto Rican default, and Greek bailout saga, among others, suggest the appropriateness of a rate hike. Not to mention that not only is the U.S. government the most indebted entity in global history, but the Fed itself has the largest, highest duration portfolio of toxic treasury and mortgage bonds in history. And that, unlike the British pound, the US dollar is in fact exploding higher, just as I predicted nearly 2 years ago when essentially everyone else in the precious metal community was claiming otherwise. Not due to US economic strength, but a liquidity vacuum as the global economy collapses, particularly in commodity-focused nations, which is exactly what corporate America fears the most. Not to mention the White House itself, which several times this year has flat out warned the Fed of the damage the strong dollar is doing to the US economy. And oh yeah, last but not least, market interest rates are not rising, but falling. But don't worry, the Fed is going to raise rates anyway, the propaganda claims, as yesterday's statistically insignificant, arbitrarily calculated, government-manipulated Island of Lies ISM Service Index jumped from 56 in June to 60 in July, contradicting every other piece of economic data on the planet, reviving claims of the mythical service boom I wrote of earlier this year. Like the non-existent housing recovery, other than in multi-million-dollar 1% homes, of course, as evidenced by the utter freefall of lumber prices, single-family housing starts and permits, and mortgage applications. And get this, whilst the aforementioned Challenger layoff report reported its highest monthly layoff figure in 4 years, and oil prices collapsed to Hades, said ISM Service Index purported, drumroll please, its largest monthly employment component jump ever. Yes, just like this morning's weekly jobless claims number sitting at 40-year lows, whilst labor participation is back at 1960s levels and real wages at 1970s levels, which, by the way, I this week discussed in detail in claiming such low jobless claims were not due to labor hoarding, as some people claim, but the simple fact that America is now a, as they say, gig economy, wherein nearly all new jobs are contract jobs, not eligible for unemployment insurance. And the reason they're all contract jobs is because of the costs of regulation are so high, including Obamacare, that people just don't want to hire full-time employees. And thus, I could only shake my head in incredulity when I read the money market's reading of the odds of a September rate hike suddenly spiked which in my view can only be due to Federal Reserve manipulation in its relentless attempt to convince the world that if it can just raise rates by 0.25% in September, a full year after QE supposedly ended, and 6 months after Whirlybird Janet's initial prediction of a March rate hike, they can proverbially prove QE was a success, which of course they hoped to achieve by manipulating stocks significantly higher, bond yields marginally higher, the dollar marginally higher, and PM significantly lower. Unfortunately, based on all I've noted above, such manipulations are backfiring, as stocks are clearly weakening, bond yields falling, and the dollar exploding higher. And as for precious metals, they have, I guess, succeeded in crushing them, at least in the paper world, as opposed to the physical world where demand is exploding and supply vanishing. However, their maniacal paper suppression games have now gotten so out of control, the gold and silver mining industry has, for all intents and purposes, been destroyed. And now that base metals are free falling as well, remember, half of all silver production is byproduct of copper, zinc, and lead mines. The outlook for precious metal supply has never been direr. And this, when all objective measures of demand are at all-time highs, and equally telling, objective supply measures from COMEX to GLD to Shanghai Exchange inventories are at record lows. Not to mention, global money printing is at an all-time high, and this before Janet Yellen's inevitable QE4 announcement, which, whether she can manage to bull a 0.25-point rate increase late this year in beforehand, which given the aforementioned trends I don't believe is possible, is coming much, much sooner than most can imagine. And as for today's Audioblog primary topic, for those that actually believe that not only is the Fed about to materially raise rates, but that gold and silver prices will be mauled as a result, all we can say is this: relax, avoid the propaganda, and embrace reality. For one, there has never been any material correlation between rates and gold prices. Heck, when gold hit its inflation-adjusted all-time high in 1980, rates were soaring. Secondly, there hasn't been a correlation between gold and the dollar in a decade, as there shouldn't be, as the fact that the euro is collapsing, the euro being the primary component of the dollar index, and by the way, number 2 is the yen, is as gold bullish as any fundamental factor imaginable. Thirdly, we are talking about the potential for rates to rise from zero, where they have been for 7 years, including when gold was taken from 1920 4 years ago to 1090 today, to by no more than a quarter or a half of 1%, amidst an environment of a record cost of living and rapidly expanding debt and money printing. And last, but far from least, gold and silver prices have been suppressed so dramatically for so long they no longer have any semblance of reality, particularly in the paper market where, the so-called commercials that run the government suppression scheme not only have their smallest short position since 2001 when the bull market started, but appear on the verge of going long for the first time since prices bottomed that very same year. In other words, whether rates stay at zero, plunge to NERP levels, or go marginally higher, the cartel's fate is sealed in stone, and clearly even the banks that run it know this. Remember, it was J.P. Morgan himself that said only gold is money and everything else credit, which is probably why, if you believe the numbers, J.P. Morgan's paper shorts have fallen to multi-decade lows and physical holdings to multi-decade highs. Irrespective, never take your eye off the fundamentals, which in my 26-year career have never been more precious metal bullish, nor more equity, fixed income, and otherwise mainstream asset class bearish. And don't for a second forget what Miles Franklin's president and co-founder, Andy Schectman, has said every day since the bullion industry ran stone dry in late 2008, which is that it will be the inability to procure metal, particularly silver, during the upcoming financial crises that will define the bullion industry's demise. Consequently, we can only reiterate, as vehemently as possible, that the time is now to protect yourself while you still can. Here at Miles Franklin, we have conducted business for 26 years without a single registered complaint, and can help you not only with the purchase, sale, or storage of precious metals, but a variety of financial planning strategies we have honed over 2 decades of working with gold and silver. To that end, I taped a podcast earlier this year with Andy Schectman regarding swaps, trades, and repatriations, and last month, State of the Bullion Industry, in which Andy spoke of matters investors must be aware of in the current environment, as exemplified by last year's Chapter 11 bankruptcy filing by long-term low-price competitor Tolving, and last week's a fellow long-time low-price competitor, Bullion Direct. As for Miles Franklin, all we ask is that you give us a call at 800-822-8080 and allow our staff of professionals, who on average sport 22 years of industry experience, to give you a free consultation. And as always, I can be reached via email at ahoffman@milesfranklin.com. Thanks and have a great weekend.